Ladies and gentlemen, I hope you are ready for an absolutely crazy week ahead. From earnings, economic data, potential continuation into small caps. Hell, let's throw some political volatility in there as well. The S&P 500 seems to be going through the initial start of a correction, and we'll see what happens next. All of these factors will be very influential in this upcoming week because we have big economic data, big earnings, and apparently Joe Biden was said to be stepping down at some point today. That news is not official yet. It has not came out, but that would cause a lot more uncertainty and likely more selling in markets. But first, before we get into all of that information and everything you need to know for this upcoming week, let's start with some Tom Lee news. Specifically, Tom Lee shares this clip that's 50 seconds long from the Compound and Friends podcast or show on YouTube. This is something I watch every single video on or episode on, if you will. It's very informative. They bring institutional clients on their show and talk about markets and what's going on. And it's Josh Brown that hosts it, an incredibly talented individual. But Tom Lee shared this specific clip like 3 times on his X account. And here he says IWM with some hard eyes emojis, and they're specifically talking about this small cap rotation.
Can we now say that there is a new trend, or is this just counter trend and we're all going to forget about it in a week?
The breadth statistics say this is new. This is a fresh move higher. You had 70 or 70, I want to say 75%. I might be skewing that number of Russell 2000 stocks trade to a 1-month high this week.
Wow.
That is historic.
Yeah.
Right? The strongest in however many years.
It's a breadth thrust. A bread thrust. No, but it is though.
This is a breadth thrust.
Yeah, you want to buy those.
Yeah, breadth thrusts coming off of major lows, which you could make the case the Russell is in the process of doing that, should be bought. Yes, they can be short-term climactic, right? I wouldn't be surprised if small caps then just declined and had some volatility for the next month or so, especially because seasonals, elections, whatever you want to call it. But more often than not, the forward returns are very bullish.
And I'll just tell you right now, it's either going to be very bullish or very bad, because normally when you get these big breadth thrusts in the small caps, it's usually coming out of bear markets. It's usually the COVID bottom, the 09, 08 bottom, the 2000 bottom, where you get these breadth thrusts in the Russell compared to the S&P, but we're at all-time highs. So this is kind of uncharted territory that we are in with this recent rally in the Russell, which may have negative implications for the S&P 500. We'll have to wait and see. I think a lot of what we get next out of markets will be determined by the political uncertainty, by earnings, as well as economic data. Monday, tomorrow morning, you have Verizon, Truist Bank. In after hours, you have Cleveland Cliffs, Nucor, NXP. NXP does a lot of their business directly, like 50% of their business with Apple. So that's a pretty good heads up of maybe what Apple's earnings could be. So that'll be important. Cadence is a big semiconductor name. AGNC also on there as well. And Alexandria and Zions. Someone has a big short on it. On Alexandria, I was listening to that on CNBC, so that could be interesting for potential trade. Tuesday pre-market, Spotify, UPS, GE Aerospace, GM, Coca-Cola, Lockheed Martin, Comcast, Polaris, and Philip Morris International. And then Tuesday and after hours, Tesla, Google, Enphase, Visa, Texas Instruments, Chubb, Seagate, Capital One, and PCA. Wednesday pre-market, Vertiv, AT&T, Next Era Energy, Thermo Fisher Scientific, and GE Vernova. And then Wednesday and after hours, Chipotle, Ford, ServiceNow, IBM, Viking, Las Vegas Sands, Whirlpool, and Waste Management. Thursday pre-market, American Airlines, AbbVie, Hasbro, Honeywell, RTX, Southwest, AstraZeneca, Keurig, Dr. Pepper, and a couple of others there. Thursday after hours, Dexcom, Skechers, Texas Roadhouse, Deckers Brands, Boston Beer, Juniper, Lending Tree, and a couple of others, smaller companies. Friday pre-market, Bristol Myers, 3M, Charter, Centene, and some others like Colgate's and T. Rowe Price. Now, we do have some pretty important data as well this week, and I just want to say this as clearly as possible. The biggest potential threat to Tesla in terms of getting a 30, 40, 50% downside move from here, it's not Tesla itself. It's not anything Elon's going to say. It's not Tesla earnings. It's not a failed robotaxi event, although that would be pretty bad if we did not get an estimated start date for the robotaxi. It's the economic data. It is the economy worsening. That is what causes a large crash in our markets. And this week, we're going to get a lot of new information on just the economy. So on Monday, tomorrow morning, Chicago Fed National Activity Index, expecting that to come in a little bit better than last month. But that's it for your Monday. Couple bond auctions here. Really not going to be important. Tuesday, existing home sales month over month. And for the month of June, Richmond Fed Manufacturing Index, Richmond Fed Services Index, 2-year bond auction, 42-day bond auction. Not huge deals there compared to the data that we are going to get throughout this week. On Wednesday, you're going to get S&P Global Composite PMI and S&P Global Manufacturing PMI, as well as S&P Global Services PMI for the month of July. You're expecting these numbers to fall slightly. The composite PMI to fall from 54.8 to 54.7, manufacturing to fall from 51.6 to 51.5, and services to fall from 55.3 down to 55. So you're only expecting a marginal down move for all of those, PMI surveys. And if they do fall more, that could be problematic. Now, if they rise, that's going to be good news, but I think you're kind of skewed to the downside given the recent data that we have seen. On Thursday, durable goods orders month over month, you're expecting 0.3%. Last month was 0.1%. So that would be a pretty dang good number coming off of 0.1% month over month. 0.3% would be a great number. GDP growth rate quarter over quarter advanced data for Q2. Your first estimate for Q2 GDP is expected around 2.5%. The consensus here is 2%. Forecast is 2.5%. The last quarter GDP was 1.4%. So you're expecting an uptick in GDP, which again doesn't really make sense given the other data that we have seen kind of look downwards in the last quarter. So I think there could be room for a downside surprise here from the actual GDP numbers. So keep that in mind. Potential risk for Thursday. Lower GDP is not going to be seen as good news. That's going to be seen as bad news. But it could raise the odds of the Fed cutting rates more. You're also going to get initial jobless claims, expecting that to come in a little bit higher than last week as well at 247,000, and continuing jobless claims expected to also rise about 2,000. So that'll be important because that's more current looking on the state of the labor market. There's a lot of lagged data on the labor market, but those initial jobless claims are coming in every week. And they are signaling a spike. They are signaling things are getting a little bit worse. Now, at 10 o'clock in the morning on Thursday, because all that data comes out at 8:30 in the morning, at 10 o'clock in the morning on Thursday, you will get the Kansas Fed Composite Index and Kansas Fed Manufacturing Index. But by then, we're going to be paying attention to the other data anyway, so I doubt that's going to move too much. On Friday, you get core PCE price index month over month, expecting 0.2%. Last month was 0.1%, so actually expecting a rise in core PCE. That would obviously not be great. Personal income month over month is expected at 0.4%. Last month was 0.5%. And you want to see wages start to catch up to some of the inflationary pressures we have seen, but not feed into this wage price spiral. You don't want to see inflation going up and wages going up. Wages going up by themselves is okay because you're just catching up to the inflation we've already seen in the actual economy. Hopefully that makes a little bit of sense. If you're curious on that, questions down below in the comments section, go ahead and post them. Personal spending month over month. This is a very important one. You're expecting 0.3%. Last month was 0.2%. So you're expecting spending to pick up as well. And when spending from the consumer is over 2/3 of the economy, it's vitally important that people continue to spend money. So again, it's not just the earnings that will be important this week, it's also the economic data. And there were a lot of rumors over the past week or two that Biden could step out of the presidential race as soon as Sunday, which today is Sunday, tomorrow is Monday. We have not heard that news yet, but if that news does come out at some point today, then that could be a very problematic thing for markets coming this week and something to be on the lookout for. The S&P 500 is already kind of nosediving straight down, and odds are you're probably going to go through a correction here as is, and political volatility, or political uncertainty I shall say, can make that even worse. Now, just to get into a little bit of statistics that I know the bulls are going to love, the Russell 2000 up 11.5% in only 5 days, one of the best 5-day rallies ever. Ryan Dietrich on X says, I found 10 other times it gained at least 10% in 5 days using the first signal in a cluster. You were higher a year later, 8 of them, and up 25.4% on average. And again, it usually happens, as you can see from this, when you're coming out of a bear market, which is just how crazy it is right now, because we're not even close to a bear market. We're not even in a correction. We're off like 2% from all-time highs on the S&P 500. But I think the reasons for the outperformance in the Russell are very strong, or the bull thesis, the bull case for the Russell's outperformance over the next couple of years is very strong. Faster EPS growth than the S&P 500, much lower valuations, interest rates coming down. As long as we avoid a recession, the Russell is the place to be over the next couple of years, in my personal opinion. Now, again, keep in mind there will be this bias to quality, so everything will do well when you get these large rallies, but the quality, the profitable companies will outperform the bad companies, the unprofitable companies, the companies that are destined for bankruptcy. If we take a look at the CNN Fear and Greed Index, you're sitting at 49, which is about as neutral as you can possibly be. If we are really going into a correction, usually you don't leave that correction until you're in extreme fear or in the lower bounds of fear. So still, there can be quite a bit of selling left from the CNN Fear and Greed Index indicator. The percent of stocks trading above their 50-day moving average hit a high of about 77%, now back down to 63.4%. Still overall strong numbers here, and that just kind of means there's more room for these stocks to continue to sell if we do go through a correction, if the earnings or the economic data or political volatility do come back stronger into our markets in this upcoming week, which I think is still unknown. Your latest AI investor sentiment survey shows 52.7% of investors are bullish, 23.8% are neutral, and bearish investors are sitting at 23.4%. Option activity on Friday from big money. Looking at the interesting flow sentiment, you have seen 60 orders totaling $33.77 million with a positive order value of 62%. So on Friday, it was actually a little bit more positive than not for S&P 500 option activity. Now, if we take a look at this Friday's option expiration for the S&P 500, on the call side, you have open interest of 25.37%, open interest on the put side of 74.63%. That is a put to call ratio of open interest of about 3. So there's about 3 times as many puts than calls for the S&P by this Friday. And if we do continue to go through this corrective phase in our markets, I really think you just want to watch your moving averages. 50-day moving average at $538 per share, 100-day moving average at $524 per share, and your 200-day moving average at $491. A good correction would be us hitting that 200-day moving average. That would be the average correction during an election year, which I do think there is plenty of reasons for an average correction during this election year of about 13%. From top to, potential 20-day moving average, that'd be a 13% correction, almost perfectly. So do we get down there? I don't know. If we get down to this 100-day moving average, that would be a correction of 7%, and down to the 50-day moving average would be a correction of almost 5%. I think we probably need more than 5%. 7% could be appropriate, but 13% would be a good correction, and that would be a great opportunity to get reallocated to markets in areas that maybe you're not as allocated to, that you want to be as allocated to. Because I think the end of this year, as long as we avoid a recession, the Fed starts to cut rates, 2025 is going to be a fantastic year for investors, and you're going to make a lot of money. So I think you want to be allocated to this market as much as possible, but you also probably don't want to be allocated to the areas that are already super expensive, that are already pricing in almost perfection for the next couple of years. And we all know what those names are. I think that's where the Russell provides a very attractive opportunity right now. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.